Hey everyone, welcome back to the channel. Quick video today on the update with the stimulus bill. What's in it, what's not in it. There's been a lot of changes and when will it be passed, talking about all of that here in this video for your update today, as well as discussing some unique proposals such as the wealth tax. And if you're a billionaire, I'm sorry, not really, I mean, that's pretty good for you, but you're going to be hit with a lot of taxes if this thing passes. All of that and more in this video. My name is Kevin Conway. I make personal finance videos all the time, so please like and subscribe to the video if you have not done so already. Now let's jump right into it. So where are we? Instead of 3.5 trillion, we're at $1.85 trillion for the latest social infrastructure bill, the bill that is separate and apart from the $1 trillion infrastructure bill that has already been passed, but is tied together with one another because the passage of one requires the passage of the other. That's where we are right now, $1.85 trillion. So down from 3.5 trillion. So what is not in this bill? We know that free universal community college is not in this bill anymore. That is gone. We also know that 12 weeks of paid family leave, that is also gone in this bill, with Senator Joe Manchin specifically saying he does not want the paid family leave in this bill. It's not the time and place for it in a reconciliation bill. We also know that tax increases for certain individuals who make certain income is also not in this bill, along with corporations. So we know that Kyrsten Sinema out of Arizona is not going to support a top marginal tax rate increase on individuals or corporations. That leaves the Democrats with really only a few things that they can do. They have to be creative with their tax proposals, which brings us to the wealth tax proposal, a brand new thing in American government. So here's how the wealth tax would work. It applies if you make $100 million of income for 3 consecutive years, or you have $1 billion of unrealized capital gains. Now, what does that mean, unrealized capital gains? It means that the value of the assets that you hold goes up in value and it has a paper gain, but you haven't sold it and put the money into your pocket. It is unrealized because you have not realized that income yet. This is a dramatic shift from what has been the historical taxation of income in this country as opposed to the taxation of wealth. So by and large, for the entire history of the United States, we have not taxed wealth, but we've taxed income. There's been some exceptions and some nuances there, such as property taxes, which is, in my view, kind of a tax on wealth. But with respect to income and increases in personal wealth, we've not taxed this until right now. We are proposing the billionaire's wealth tax. Now, this is going to be very difficult to assess because you're going to have to calculate the value of assets which are not publicly traded. For those that are publicly traded, such as Jeff Bezos' Amazon stock, that's very easy to do. And you're able to look at that stock and see how much it's gone up in value and then tax it. So what is this tax specifically? Well, it treats unrealized capital gains above that amount as if they were realized every single year. So what that means is, say Jeff Bezos' stock goes up from 100 billion to 150 billion. Well, it would be in the eyes of the IRS as if he had gained $50 billion of taxable income during that year, taxed at the capital gains rate. So that's 23.8% today, and they want to increase that, or maybe it doesn't go up as high, but that's basically how it works. So he would owe $10 billion. Now, you'd have about 5 years to pay that, but that's basically how it works. And if the value of your stock went down, you can carry back your losses if that occurs. Just basically how you can carry back your stock losses today. Now, this is very difficult to understand because there's a lot of complexities, especially with respect to things that aren't publicly traded, such as real estate holdings. And there's a whole mess we can go down and actually determine whether or not the IRS is going to be able to do this in the first place. But here's a few key pieces of information. Number one, is this constitutional? Well, in my view, and I'm an attorney, I'd say probably not, but the Democrats probably don't care, and that may seem very unusual, but here's what I mean. Well, the income tax was only constitutional because we ratified the Constitution with the 16th Amendment in 1913. As a side note, when the income tax was passed back then, it was only 7% maximum. 7% maximum, your top marginal tax rate, and that only applied qualified if you made the equivalent of around $13 million today. So you can see very interestingly how an income tax put in place in 1913 grew to where it is today. But that's an interesting aside. Regardless, the income tax was only allowed in the Constitution because we amended the Constitution with the 16th Amendment. And basically, here's what the amendment says. The Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. Now, historically, income meant the actual receipt of money. The receipt of that money, whether it be as a business receiving money from sales, as an individual receiving money as a paycheck, that was income. It was not income to have the value of your assets increase. If you owned a painting and it was worth more the next day, no one considered that income. Therefore, it's probably not constitutional. Interestingly, and a very small wrinkle, that last portion about how it must be apportioned among the several states, that means it cannot be specifically targeted to single out specific regions of the country or specific individuals. That's why you never see tax bills that say Jeff Bezos must pay 10% of his entire wealth. Here, everyone pass it, go on. You cannot do that. That is illegal under the Constitution. And you cannot say only California will pay this tax or only Georgia will pay this tax. It has to be apportioned among the several states. Now, whether or not it falls on that leg, I don't think so, but it probably won't pass because under the current constitutional rule and under the current right-leaning Supreme Court, this wealth tax is probably not going to pass. Now, let me know what you guys think in the comments below, whether or not this is a good idea or a bad idea. I'm very curious. Many people have said this is a good idea. These billionaires have made so much money, they should pay some of their money. Joe Manchin wants a 15% patriotic tax. He hasn't spelled out what that means, but that's pretty much aiming at what what a lot of people feel, which is that the wealth has concentrated in so few, and we should distribute that more evenly. And other people say, look at France, look at Switzerland. They've tried a wealth tax, and the rich people just simply left, and they had no tax at all for those people. Let me know what you guys think in the comments below. Getting back to what is in the bill, we know that there are certain things that have been left in the bill from previous iterations, such as an expansion of kindergarten and pre-kindergarten for all 3 and 4-year-olds, of free pre-K for everybody in the whole country, but only for 6 years. Now, why is it only for 6 years? Well, it's only for 6 years because according to the rules of the Senate, you must pass a bill that is revenue neutral if you use reconciliation. As a result, on paper, this spending will only last for 6 years, but the revenue collection will last longer than that. Therefore, it helps balance out the deficit. Now, whether or not it lasts for 6 years, I don't think so. The Congress will probably, if this passes, pass it again at that time. Now, going back to the wealth tax and the Democrats not really caring whether or not it's constitutional, well, it's for that exact same reason. If you pass a bill today, and according to the paper today, it actually balances out, it can pass via reconciliation, irrespective as to whether or not the actual revenue-raising procedures in that bill are constitutional. If it turns out a year from now the Supreme Court strikes down the wealth tax, well, it doesn't matter because the bill's already been passed and the money has already been spent. So that's basically the gamble that some Democrats are looking at and playing right now and saying this is a popular bill. It is going to help us get reelected. And when the bill comes forward and we pass it today and the revenue-raising procedures are dropped in the future, that won't really matter because this public support will be behind it. There's also subsidies for childcare in here. If you make less than 250% of the median income of your state, you will no longer have to pay more than 7% of your annual income in childcare expenses, so long as you are working or seeking work or somebody who is seriously disabled. So that is in this bill as well. Some more taxes in this bill is a 15% minimum corporate tax if a corporation makes more than $1 billion, and a 1% excise tax on stock buybacks, which a stock buyback is when a company purchases its own shares and reduces the total share count, leaving the remaining shareholders with more of a percentage of ownership in the company and more of a share of the profits. That is how a lot of companies do returns of capital to their shareholders, just like dividends, only they are not taxable to the recipient, which is why the Democrats want to impose a 1% excise tax here. So another couple interesting provisions in this bill include those related to climate change, which includes $555 billion for climate change subsidies to help utility companies, transitions, or consumers get onto green energy. For example, we know that according to the Wall Street Journal, They include $320 billion for a 10-year expanded tax credits for utility scale and residential renewable energy transmission, electric vehicles, and clean energy manufacturing. So that would be subsidies for electric cars or solar panels or whatever it may be to help the grid. So we also know that there's $105 billion to boost resilience on the effects of climate change, like wildfires and droughts in California. We have a big problem there. $110 billion to grow the supply chains for renewable energy, and $20 billion to incentivize the government to purchase cutting-edge energy technologies. So we know that this is a major focus of the Biden administration. A huge portion of this bill, about a third of it, is related to climate change. We also know that Medicare is being expanded, but only to include hearing benefits, not the originally proposed dental or vision. We also know that the Obamacare subsidies are going to be expanded until 2025. Now, those are the major provisions here in this bill. Let me know what you guys think in the comments below. I'm really curious to hear, and I'll see you next time. Thanks.